Welcome, accounting boffins out there. You are with Ashraf Patel and the crew. And today, we're taking off on the flight called Bank Reconciliation. Right. Now, what you have to remember is that always ask yourself, what is the relationship between a bank and the business? Okay? And obviously, remember the word reconciliation means to bring together. You reconcile differences, you sort out your problems. If you're having a challenge with somebody, you reconcile, you bring together. So the word reconciliation means to bring together. Right, what are we bringing together here? We are bringing together the balance as per your bank account and your bank statement. But more about that later. Okay, let's look at this relationship between a business and the bank. It therefore means that the business is going to deposit its money into the bank, right? So you can see the movement of cash from the business, obviously, into the bank. And then what happens? You have your records. What are your records? Your bank account, right? When we say your records, we're talking about the business. And the business has its records, which it keeps, and obviously we know about it when we receive our bank statement. Okay, now, the differences between the two, the bank account as per our records and the bank statement as per the records of the bank, gives rise to the bank reconciliation statement. Clear? So you can see the need, right? Therefore, in the business world, what do we have? Your cash is facilitated by depositing your sales and other receipts intact. What I mean by intact is that as we receive the money is not taken out by anybody. As we receive the sale, for example, if there's a sale of 500,000 Rand, the entire 500,000 Rand gets deposited into the bank account. Okay. And therefore, it ensures that all payments are made either by check or by EFT. Now, let's be wary about this. Obviously, checks are coming to an end. The usage of checks will very soon be out of the system in South Africa because the movement is towards EFTs. What does an EFT stand for? Electronic Funds Transfer, right? However, you still need to know about checks, but remember, it's on its way out, being replaced by EFTs. Right, now what happens here? We are going to receive a bank statement from our bank, right? Telling us these were the transactions that we entered into for the month under review. So remember, this is your external document. Clear? And then, obviously, you have in your general ledger a bank account where you're keeping records of the transactions that you entered into with the bank. So therefore, the balance as per your bank account is your internal record. So clearly you can see now, you're receiving the bank statement from the bank, you have your bank account in your general ledger, so clearly a comparison needs to be made in order to understand why the differences. Okay, then we said that you're going to manually check. What are you going to do? You're going to verify all your deposits that you have made to see whether they appear on the bank statement or not, right? And you're going to check whether all your check payments or your EFTs are also appearing on your bank statement. Okay, so keep that in mind. Now, there's absolutely no difference in terms of the transaction being recorded, whether we're issuing a check or whether we're processing an EFT. It's a payment made from our bank account, right? But obviously understand, a check means it is written out and then physically presented for payment, whereas an EFT is a direct payment, a funds transfer out of our account into the person's account or the creditor's account that we are paying. So you will now compare the bank columns of your CRJ and your CPJ, that means our records, and this should then correspond with the bank statement, right? So obviously, what do we do now? You check your cash receipts journal against the credit column of your bank statement, and you check your cash payments journal against the debit column of your bank statement. Very important. Remember, and this is the crux of the bank reconciliation statement, right? If you understand this point, I promise you, bank reconciliation will be something that you will properly understand and also be able to use it. Remember what I've always said, accounting is a life skill. It teaches you a life lesson. So even though you may not be studying in the accounting field, you're someday going to have to draw up a bank reconciliation for your own bank account. So therefore, guys, accounting is a life skill and an important one. So therefore, look at the different points of view. The business regards each transaction from its point of view. This is what the business sees. And the bank regards each transaction from an opposite point of view. Okay? I'm going to explain that. Now, obviously, this relationship between us and our business, I repeat, the relationship between the business and the bank, right? Between us and the bank is one of debtor and creditor. Have you ever thought about it? Let me explain. In our records, remember, we're the business, we have money, meaning it's a debit balance, it's an asset account. We have cash according to our records. However, if you're looking at the bank records, now change your perspective now. What will the bank say? The bank will say, we are owing that money and therefore we have a credit balance. So a debit balance in our books means a credit balance in the books of the bank. Can you see a debtor-creditor relationship? We are telling the bank, you owe us money. The bank says, we owe you money, right? Debtor-creditor. Okay, and obviously, if we have money, it's an asset in our records, it's an asset in our books because it's something that the business possesses. On the other hand, in the books of the bank, it's a liability, meaning they owe the money to the respective businesses. Right, now, let's change the perspective now. What are we saying now? If we owe the bank money and the bank is in overdraft, important term, overdraft. And overdraft means we've used up more money that we have, and therefore we are owing the bank money. So clearly, in our books, this is a liability and obviously a credit balance. Let's change the perspective. From the view of the bank, what will the bank say? The bank will say, we have a debtor, right? The bank will say, we have a debtor, somebody owes us money, and therefore it will be an asset in the books of the bank. So clearly, accounting boffins out there understand the relationship between us and our bank, right? Okay, let's take an example. If we deposit money into our bank account, it's in my CRJ, right? Whereas in the books of the bank, they will put it on the credit side. A very simple example. Let's take it to a very simple example for you to understand. If we saying that we're depositing 1,000 Rand into our bank account, according to our records, we have 1,000 Rand. If we look at the perspective of the bank, what will the bank say? The bank will say, we are owing you 1,000 rand. Can you see it? We have a debit in our books and a credit in the books of the bank. So always understand, when you're comparing, compare your CRJ with the credit column of your bank statement. By the same token, compare your cash payments journal with the debit side of your bank statement. Clear, guys? Okay, let's take another example. If there's a check or an EFT payment, right? What happens to our bank account? It's an asset decreasing in value, therefore we credit it. So what's the bank going to do? Obviously, the bank will debit it, and therefore they will say money has been taken out of this account, and therefore we owe the business less money. So clearly you can see the relationship between us and our bank is that of a debtor and a creditor. And if you understand that, that's the bottom line. That's the baseline assessment that you have to do to make sure that you understand what is a bank reconciliation statement and why the need to draw up a bank reconciliation statement. Okay, now, let's just carry on with this example to make sure that we fully comprehend what we are doing. We said that if our records are mirrored, right? They are mirrored in terms of the bank records. So every time we debit something in our books, it is credited in the books of the bank. Let's take another example. If we make an EFT payment of 5,000 rand, right? Remember, what's happening to our records? In our records, obviously, the EFT will be recorded in my cash payments journal. Why? It's an asset decreasing in value, so my bank account is decreasing. In terms of my records, I have 5,000 rand less. Why? I've paid out of my account. Okay, but now look at it from the perspective of the bank. What will the bank say? The bank will say, okay, this business now has withdrawn 5,000 rand from the account because obviously the money was transferred into somebody else's account, and they will say, we are owing them 5,000 rand less. So now, clearly, this takes you back to this one here, where we look at the relationship between us and our bank, right? What do we mean by this here? Clearly we can see that in our books, we are recording the transaction. In the books of the bank, they are recording the transaction, but every time we debit, they are crediting. Every time we credit, they are debiting. And that, accounting boffins, is the crux and the basis for the understanding of the bank reconciliation statement. Okay, now definitely, this means therefore, for us, it's our bank account in our general ledger, obviously dependent on the cash receipts and the cash payments journals. Remember, you bring that into your bank account, and then you compare with your bank statement, right? And once you've compared that with your bank statement, you're now going to identify errors, omissions, and additional transactions that need to be recorded, right? So I've whet your appetite in terms of what's to come. Let's take a quick ad break, and we'll see you just now. Welcome back, accounting boffins, right? Remember, our flight has taken off, and our flight today is concentrating on the bank reconciliation statement. Let's just go through this concept again very quickly so that we understand where we are. Right, remember we said the relationship between a business and the bank, right? Our records, the bank account, and the records of the bank obviously is the bank statement, and as a result of transactions, and the deposits is just one type of transaction. Remember, there are other transactions as well. For example, payments by EFT, etc., etc., etc. All of these would then result in us comparing our records with the records of the bank, and therefore making it necessary to reconcile the two, and therefore we draw up a bank reconciliation statement. Right. Now this here is critical. A bank reconciliation statement is an extension of your bank statement. In other words, it's something that we draw up in our records to ensure that everything that we have recognized as errors, omissions, additional entries are then recorded in order to ensure that the bank account balance agrees with the bank statement balance. Right, okay, so here we go. Number one, bank charges. What are bank charges? Obviously, your commercial banks render services to their clients and must be remunerated accordingly. These charges are reflected in the bank statement. So these are your bank charges. These are charges that are levied by the banks against our account in order to render a service to us. Right, so understand, what is bank charges? Bank charges is an expense to the business, right? And therefore, what's my contra entry? A debit to bank charges and a credit to bank. Now this, people, is something that you must take cognizance of. When you receive your bank statement and you identify your bank charges, immediately you raise an expense, you debit bank charges, and you immediately credit your bank account. So this tells you that your bank charges will be entered into your cash payments journal, right? Okay. Now, what are the various bank charges that you get? You get something that is called service fees, right? For the service that's being provided by the bank. You also get another one called cash deposit fees, right? And that is why it is so expensive to deposit cash into an account. Obviously, it entails physical work where the cash has to be counted, and therefore, as a business, you should encourage your clients to rather pay you by EFT. In that way, you don't have to receive the cash and then go and deposit the cash into your account, because obviously there's a charge involved there, which is going to be an expense to the company, right? You get duty on debit entries, you get something called service commissions, your levies on credit card sales, and let's stop there for a very, very, very important reason. Right. So all of these charges, when do you become aware of them? When you receive your bank statement, right? Obviously, at the end of the period, normally around about the 20th or the 21st of the month, the bank will send you your bank statement, right? Okay, at this point, just a quick one. What type of balance would you love to see on your bank statement? A debit or a credit? Yes, a credit balance. Why? Because you want to be in a position to say, the bank owes me money. Because the moment it's a debit balance, it means we owe the bank money. Good. Now, if you understand that, you will see now. I've indicated this one here separately. Interest on overdraft. Interest on overdraft is the interest that we have to pay for using money from the bank. Let's put it another way. When you use more than what you have, your account goes into overdraft. And what is an overdraft, people? Simple, it's a loan. It's a loan from the bank. And therefore, you have to pay the financing cost on that loan. And that cost is called interest on overdraft. Now you will notice, I've highlighted it here, I've separated it. Why? Because critical information. Interest on overdraft is not a bank charge. Yes, it's a charge that's levied by the bank, but it does not fall within the ambit or the umbrella of bank charges. All of these here that we've mentioned would fall within the category of bank charges. You don't open up separate accounts for service fees and debit entries and cash deposit. No, all of these charges would fall within the umbrella of bank charges, right? The one charge levied by the bank is not a bank charge, and that is interest on overdraft. Why? Because interest on overdraft is not an operating expense. Not every business will have interest on overdraft. If you are not using the bank's money, then certainly you will not have an account called interest on overdraft. You won't be paying any interest. On the contrary, if you have a favorable bank balance, you'll be receiving interest from the bank, and that is interest on current account. But we'll get there. This interest on overdraft must always be shown separately. Why? It is not an operating expense. It is a financing expense. And therefore, accounting boffins, you know when you are drawing up your financial statement, namely the statement of comprehensive income. Remember, bank charges would appear as operating expenses. However, interest on overdraft appears at the bottom of my statement of comprehensive income, also known as the income statement. And there you have interest expense. And one of the components of interest expense is interest on overdraft. Now, can you see, if you had put it into the same account as bank charges, you will not be able to identify it as a separate item. So remember, interest on overdraft, a separate item, its own account. And I've explained to you why that is. To conclude, it is not an operating expense. It is a financing expense. Got it? Brilliant. Let's move on. So, when a bank charges us these particular expenses, right? Obviously, the bank has rendered services to us, and as a result of that, they have to be remunerated. These charges are reflected in the bank statement. It means you only become aware of them when you receive your bank statement. Okay, now that you've received your bank statement, you are able to identify and say, right, these are the items that are appearing on my bank statement. Cash deposit fees, service fees, etc., etc. Remember what we said? All of these would be put into one account, namely bank charges. Okay, now your bank account adjustments. Why is there a difference? The differences occur as a result of one, outstanding deposits, right? You have made a deposit in your records. However, when you receive your bank statement, it is not featuring, right? Now be careful, outstanding deposits. And let me just use a bit of time to explain this one here. If you've made a deposit on the 25th of the month, right? But you have received your bank statement on the 20th of the month, obviously guys, that outstanding deposit that deposit cannot appear on my bank statement because of a timing difference, nothing else. However, if you have made a deposit on the 4th of the month, and by the end of the month, that deposit is not reflecting on your bank statement, keep your eyes peeled. That is a possibility of rolling off cash. What do we mean by rolling off cash? sounds very fancy. Rolling of cash is actually fraud. It's theft, where somebody that's dealing with the cash in your business is using the money for personal gain and then at a later stage going to deposit that money. It's illegal. It constitutes a crime and it is theft. Okay, guys? Checks that are not presented for payment. You've issued a check, right? It's in your records. It hasn't been presented for payment. Okay, obviously, that's legitimate. There may be a reason why the check is not presented for payment. No problem. However, if you find that this check is now outstanding for a long time, and the criteria that we use is it has to appear in 6 bank reconciliation statements before it becomes a stale check. More about that later. Right? So you see, there I said, there's your stale checks. Right? So what do we mean by a stale check? A stale check is a check that has been issued, and for 6 consecutive months, it does not get presented for payment. In that case, at the end of the 6th month, that check is now stale, meaning it is no longer negotiable. That person cannot present that check for payment any longer. Right? We'll have to look at the reasons why it is stale and do the necessary. More about that later. Right? EFTs that are not processed. Simple. Again, you have received your bank statement by the 20th of the month, and you process EFTs. Obviously, business carries on as normal. 22nd, 23rd, 25th, whenever. Those EFTs are in our records, not in the records of the bank. They need to be seen to. Right? And then obviously, if there are any errors either on our side or on the side of the bank, the bottom line with regards to errors is as follows. Errors made by us, the business, are corrected either in the cash receipts journal or the cash payments journal. But errors made by the bank are corrected in the bank reconciliation statement. Okay, we've basically just gone through some of the errors or adjustments that could affect the bank reconciliation statement. We're now going to go into detail and look at each one and see how it impacts and what your bank reconciliation statement will look like. Let's take a quick ad break, let's have a quick refresher, and we'll see you in a jiffy. Welcome back, accounting boffins. Yes, we're still in flight, and the flight is bank reconciliation statements. Remember, once again, a quick recap, the relationship between us, that's the business, and our bank, right? And we're saying, as a result of this relationship, there's going to be errors, omissions, differences. So we're going to reconcile, bring together our balance as it appears in the bank account, our general ledger. As we receive the bank reconciliation statement, the comparison takes place. Okay, now remember, post-dated checks that have been issued by us, right, are treated simply as outstanding checks. They are not presented for payment. However, there's something else that we need to take cognizance of, and that is, how do we treat these with regards to financial statements, right? So not only, now remember, you don't learn in boxes. In accounting, you've got to use your knowledge in other sections as well. And clearly you can see that if there's a post-dated check that has been issued, right? And obviously a post-dated check that has been issued means that that check cannot be presented for payment. So in reality, the money has not left our bank account. Okay? Therefore, what do? Financial statements, we add to bank, right? Remember, check the status of your bank account. Is it favorable? Increase it. If it's unfavorable overdraft, reduce the overdraft. Okay, and then you have your aid to creditors control. Obviously, that one will not change. So if somebody comes up to you and they ask you, what type of an account is bank? What's your response? Your response should actually be, it depends. On what? If it has a debit balance, it's an asset. If it has a credit balance, it's a liability because we owe the bank money, it's an overdraft. Okay. So, what's my reconciliation procedure? What do I do? Number one, update your cash receipts journal. Get information from your bank statement that the bank statement has that you don't have. Update your cash receipts journal. 2, update your cash payments journal. Again, take information that the bank statement has that you do not have. Examples of that would be what? Checks that have an error on them and the error is on our side, right? Or bank charges, or dishonored checks, or interest on overdraft. So all of these items will now be taken into consideration to update our cash payments journal. Just on the cash receipts journal, what would appear in my cash receipts journal could be a direct deposit, money transferred directly into our bank account, right? Interest on current account, where we are receiving money from the bank. Remember, we will only be able to get that when we peruse our bank statement and see, yes, here's an item, we earned interest on our current account, therefore into my CRJ. Once you've updated the CRJ and the CPJ, you now complete your bank account, right? And thereafter, you prepare your bank reconciliation statement, and like we said earlier on, remember we said this, and I want to repeat it, the bank reconciliation statement is an extension of your bank statement. So your last balance in your bank statement is where you start off your bank reconciliation statement. You start off from there and you bring in all the entries that need to update your bank reconciliation statement. And you'll see just now which ones we're referring to. Okay. Let's take an example of errors that we may have made in our journals. Number one, if the amount is overstated, in other words, it's 509 in our CPJ and the correct amount is 309. Now remember, 509 is appearing in our CPJ, whereas the correct amount of 309 is appearing in the bank statement. Obviously, the bank statement is correct because that check was presented to them and they can clearly see that the amount was 309. We overstated the amount in our CPJ. How are we going to correct it? By making an entry of 200 Rand, the difference between the two, where? In the cash receipts journal. So if it's overstated in my CPJ, make an entry in your CRJ with the difference. Clear? Right. Then, if the amount is understated, meaning in our books, the amount is appearing as 205 instead of 1,205, meaning that clearly you can see we have understated the amount. It's supposed to be 1,205, which is correct as per the bank statement. Our books are incorrect. What do? We enter, we make a supplementary entry, we make another entry in our CPJ with the difference. So these are errors possibly that we could make. That's the business. Okay. Now, if the bank makes an error, okay, it's possible, it happens, either what you're going to say is debit incorrect credit or credit incorrect debit. For example, just to give you an example, the bank processed the bank charges twice on the bank statement. That means they debited your accounts 2 times. Clearly you can see the one debit is incorrect. How will you correct it? In your bank reconciliation statement, you'll say credit incorrect debit. Clear? Okay. So now, this is what your bank reconciliation statement looks like. What does it have? One, you start off with outstanding deposits, right? What I haven't done here is I haven't given you the opening balance as per your bank statement and the closing balance as per your bank account. Obviously, those are two givens, right? So what must your bank reconciliation statement have? It must have your balance as per your bank statement. Now remember, the closing balance as per your bank statement. Because remember, if I say it's an extension, so if I'm extending a room, wherever the room ends, I extend from that part onwards. By the same token, a bank reconciliation statement is an extension of your bank statement, and therefore, where your bank statement ended, that's where you start off your bank reconciliation statement. So obviously, it's either credit or debit balance as per bank statement. Now, which items would appear? One, your outstanding deposits. That means deposits that are appearing in our records, but are not appearing in the records of the bank, would appear in my bank reconciliation statement as credit outstanding deposits, right? Then I would also look for checks that are outstanding. That means checks that we have issued are not appearing in my bank statement. Therefore, they will go to my bank reconciliation statement as outstanding checks or checks not presented for payment. By the same token, also look for EFTs that have not been processed. Very important, people. Like I alluded to early on in the lesson, I said checks are on their way out. The movement is towards EFTs, right? And for obvious reasons. It's safer, there's less bank charges, it's quicker, and yes, what I want you to actually do for yourself, and today I'm giving you some homework, is go back and look at the reasons why we use electronic banking. Very, very important, right? So you have some homework to do today. Okay, now we say credit error made by the bank. So obviously the amount was wrongly debited. Remember I just said that just now? So in this case here, it's credit error made by the bank. So they wrongly debited you, so you're crediting the amount in order to correct it. Okay, let's look at a type of a summary. So you have all your bank charges, service fees, cash deposit fees, deposit books, check books, government levies, Now obviously these here, remember what we said? On the way out, but let's mention it because currently still in the curriculum, but definitely on its way out. Okay? And all of these charges, you have EFT charges, so that's new, right? Because the bank's going to charge you. Although it's cheaper than a checkbook, you're still going to pay for an EFT charge. It's a service that's rendered by the bank. So all of these would fall within the ambit of bank charges. Where is it appearing? In my bank statement. Where is it not appearing? In my cash payments journal, and therefore will be entered as bank charges. So all of these charges, right? You don't keep a separate account for each. You put them all, you lump them all together, same basket, and that basket is called bank charges. Okay, then you get stop orders, debit orders, and EFTs. These are appearing on my bank statement, right? So obviously, what do we mean here? These are direct payments made to a third party. It could be for various reasons, insurance premiums, water, electricity, whatever we may be paying for, right? So all of these information appearing where? In my bank statement. Where is it not appearing? In my cash payments journal. Therefore, enter them into my cash. So what am I doing here? I'm updating my own journals with information from the bank statement. Important. Remember I spoke at length about this one here, right? Quick recap. Interest on overdraft, where is it appearing? On my bank statement, right? Where is it not appearing? In my cash payments journal. Enter in your cash payments journal, but please, accounting boffins, keep it separate from bank charges. It's a standalone item. And I explained to you, it's not an operating expense, it's a financing expense. Okay. Important one, we spoke about it, but more explanation. If we earn interest on our current account, like we're going to pay interest on overdraft, if we're owing the bank money, we're going to earn interest on our current account, and therefore that interest will have to be recorded in my cash receipts journal. Why? My bank account is increasing in value. I've earned interest on my current account, and therefore I now enter it into my cash receipts journal as interest on current account. It's an income account. Keep that in mind. Okay. When you are entering into your cash receipts journal, remember, you start off with your provisional totals. What do we enter into our cash receipts journal? We enter interest on current account, right? We've spoken about that. You talk about cancelled or stale checks, right? Stale check, a check that's older than 6 months, okay? Checks that were overstated, and direct deposits by tenants or by debtors. So all of these items, right, are appearing where? On my bank statement. I'm updating my cash receipts journal with these entries. Again, with your CPJ, start off with your provisional total, enter the following: interest on overdraft, bank charges, checks that were understated, stop orders or debit orders, RD check. What is an RD check? A dishonored check. A check that was dishonored due to insufficient funds must be cancelled in my CPJ, right? And then obviously the reissue of stale or lost checks, right? Be a bit circumspect when it comes to checks. Like I told you, currently in the curriculum, but the latest trend in terms of what's happening in the country, it's moving out because checks are no longer going to be in use in South Africa, right? It's a worldwide trend. It's happening throughout the world. And therefore, the move to electronic banking. Remember, I've given you homework to do. Please read through it so that you understand exactly what electronic banking entails. Okay? What goes into my bank reconciliation statement? I start off with my balance as per bank statement, which could either be a debit or a credit, right? Then I bring in my outstanding deposits, outstanding checks or EFTs, errors made by the bank, and then the bank account as you have calculated it, either debit balance as per bank account or credit balance as per bank account. So clearly you can see this is the structure of your bank reconciliation statement. A very important part of bank reconciliations is the role of internal control. What do we mean by internal control? It is important to prepare, let's say that again, it is important that proper measures should be taken to ensure that the firm is managed in an orderly way to eliminate the possibility of fraud and theft. The procedure followed by a firm in order to prevent fraud and theft or to detect it as soon as it occurs is called internal control. In other words, what do we mean by internal control? By internal control, we mean the methods and procedures adopted within a business to safeguard its assets. Bottom line, the purpose of internal control is to safeguard the assets of a business, right? And what do? We check the accuracy, reliability of our accounting records, and it promotes operational efficiency. In other words, guys, put very simple, internal control measures are put into place in order to safeguard the assets of a business. In this particular example, the purpose of internal control is to safeguard our cash, which is the asset that we are dealing with, our bank account, right? So, Let us summarize today's lesson. Number one, what's the relationship between a business and a bank? I think by now you know clearly what the relationship is between us and our bank, right? Remember debtor creditor story? Look at the types of adjustments that could occur, the types of errors, omissions, etc. Look at the bank reconciliation process, and very, 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 very important, internal control. All of this, the reason we are doing this is to ensure that our cash is safeguarded. And that's what we mean by internal control. Well, guys, it's time for the flight to land. So from Ashraf Patel and the crew, we hope you enjoyed the lesson. We hope you understand the lesson. We have had a smooth landing. Until the next time, keep your feet on the ground and be good. Bye-bye.